So it's a Tuesday afternoon, ripped a light 10K profit on AMD calls in the morning, got a little bored, and I started to scroll through Reddit. And that's when I came across this post from Snoo Avocado. So let me just read a few parts of it for you guys here, and then we'll break it down. So he posted this in Wall Street Bets, and he titled it, "Did I Discover the Infinite Money Glitch?" So he says, "Guys, I think I cracked the code to the infinite money glitch. Hear me out. Pick some stocks you actually like and that are good for wheeling. SoFi, RKLB, Amazon, etc. Sell puts on red days, sell covered calls on green days. If you get exercise, it would either way be below a price you'd like the stock at and you'd be selling for a solid gain, blah, 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 blah. Grabbing an easy 2 to 3% gain every couple weeks. Before anyone else calls me or Theta Gang, I just like the money being mine." Okay, so the essence of the strategy he's proposing is to essentially find a few stocks you like, sell cash secured puts on those stocks on red days, and then get assigned the shares of stock and then sell covered calls on those shares on green days. So this is more simply called the wheel strategy, and it's part of the theta strategies that are found on Wall Street Bets enemy thread Theta Gang. But the question is, does this strategy actually work? And if you start reading through the 587 responses, you'll quickly lose hope that this or any strategy for that matter will ever work. So you're better off just basking in the collective misery of Wall Street Bets and never bothering to do anything but gamble ever again. So let's just read through one of these for fun. So this guy, Boney Donut, says, quote, "The wheel is a dangerous gateway into like Reddit/investing. It may seem because it involves calls and puts, but don't be fooled. It's actually very unsafe." So then Mexi Lexi said, "I read 2 to 3% and literally threw up in my mouth. Ew. If I wanted 2 to 3%, I would sell Frosties behind the dumpster." All right, so clearly mostly satire here, but what if I told you that Snoo Avocado, our poster here, was actually onto something and the wheel strategy actually worked really well? So well, in fact, that it made me $2 million in profit in 2024. And yes, I'll refresh my account here so I don't get any of you idiots in the comments calling me out, so I'll pop it up here. And since we've been reading through Wall Street Bets, I'm not only going to show you in this video how this strategy literally shits money, but I'm going to outline a 3-step guide on how to find wheel plays with higher risk and higher return that are more Wall Street Bet friendly, that might not actually make you throw up in your mouth. And I'll even make sure how to include how you can scale these strategies to work on any account size. I'm going to cover strategies that, for the sake of this video, I'm calling number 1, the ER gamble, number 2, the falling knife, and number 3, the fad strangle. These are all variations of the wheel strategy or theta strategies that we just talked about. And if you still don't believe me that these strategies actually work, I tracked every single trade I took in 2024, literally hundreds of them using theta strategies on a massive spreadsheet. I'll pop it up here for you guys. So if you guys want to download it and look through it like a nerd, that's going to be in the description. So now that I've semi-qualified myself to speak on the wheel strategy or theta strategies, let me try to show you how it can absolutely print money for you too, so you can escape the depravity of Wall Street Bets and join Option Lab, my community that's filled with people like this who make thousands a month from 70% plus probability option selling strategies rather than the complete garbage that you see on Reddit. And yes, I just hard pitched my community. So if you are here from Wall Street Bets, please leave the most disgusting hate comment down below to help my engagement. I really appreciate it. So if 2 to 3% a month sounds good to you, let's hop right into this 3-step guide on how to trade the wheel, but on steroids. All right, so let's hop right into this 3-part wheel tutorial, and specifically the wheel with higher risk and higher reward. I'm going to go through 3 different strategies, what I'm calling the ER gamble, the falling knife strategy, and then the fad strangle. And I promise, if you guys stay till the end of this video, you're going to walk away with 3 new strategies for your arsenal and never want to trade the nonsense on Wall Street Bets again. So number one is going to be called the ER gamble. And by ER, I mean earnings report. And the essential premise of an ER or an earnings play when you're selling options is as follows. And this is the key kind of like theory behind understanding why this works. So if we have an upcoming earnings report on a stock, implied volatility is higher. And when implied volatility is higher, option premium is higher. So since we are an option seller in this case, that means we get more money up front or more option premium to sell to open that option. Okay, simple enough. And this kind of, this logic here is going to be useful for the rest of the video. And if you guys do not yet understand kind of like what implied volatility is, how to sell options, click the link in the description. I'll pop my cheat sheet in there if you guys want to follow along. Okay, so what are the steps of the ER gamble? So the first step is you're going to want to scan for stocks that have an upcoming earnings report. You can do this on Thinkorswim or just on a quick Google search. So once we find stocks that have an upcoming earnings report, what we're going to do is sell sub 0.20 delta cash secured puts. So that's a lot of jargon, but I'm going to simplify that very simply for you guys so you understand if you're not new to if you're new to these strategies. So the delta of the option contract in this case, it gives you essentially the percentage likelihood that the stock stays above that strike price by expiration. So let me just draw that out here so you guys can see it on a chart, right? So let's just do it over here. So let's say we have a stock and it's moving like this. Now we sell to open a cash secured put, so -1 of, and let's just say the stock is at 100 and we sell to open the 90 put. And for doing so, we collect a premium, right? Now, this sub 20 delta portion of this means that whatever delta is associated with this contract, in this case, we'll say that this is a 0.2 delta, that essentially means there's an 80% probability that the stock stays above our 90 strike by expiration. Okay, so simple enough. If you guys are not familiar with these strategies, obviously it takes a little time to learn what I'm talking about, but that's the basic premise. So number three, if you are assigned the stock, you now own the stock at a theoretical discount, and then you can sell covered calls. So as we know, when an earnings report comes out on a stock, it tends to cause a large move up or down in the stock. Now, if you're selling sub 20 delta cash secured puts and that stock drops significantly, you're theoretically taking advantage of that buying opportunity then, and you're getting paid to wait in the meantime. Okay, so I'm just gonna give you guys an example here quickly so you have an understanding of what I mean. So I have this stock here, it's Snowflake Inc. The ticker is SNOW, and as you can see here, it's trading kind of like in the mid to low 180s. And there is an earnings report coming up next week. So I found this just off of a basic internet search. And what we're gonna do is we're gonna go through kind of like what you would do in this case to implement the ER gamble. Now, keep in mind, this is far better than what most people do, which is they would see the stock here, right? And they would buy calls, right? They'd buy calls or buy puts. And what is the downside of that strategy? The downside is if you buy calls or buy puts, you not only have to be right about the direction that the earnings report moves the stock, you have to be right about the size of the move that's made and the time frame in which that move occurs. Versus when you're selling options, all it has to do is stay above or below your strike. Okay, now that we've gotten that out of the way, let's actually look at an example. So here we have the option chain on SNOW for May 23rd, which is this next week. You can see here, and we're looking at the puts here on the right. Now, you can see here on this far right column, I have a delta. Like I said, this is going to be key for understanding the probability of this trade. And what I've picked here is the 160 put. As you can see here, it's about, let's just say $210 to sell one contract. You receive that in premium. And that contract then has an associated 15 delta. So to calculate the percentage return, right, we would take $210 divided by what it would cost to then own that stock, which is 160 times 100, which is 16,000. And I don't have the calculator in front of me, but it ends up like a little bit, let's just say a little bit over a 1% return in about a week, right? So if you annualize that out, that's pretty significant. And again, these trades aren't going to come up every single week, but it is a fantastic way to juice returns. And the question is, what happens, God forbid, if the stock now just absolutely craters and instead of going to 160, it now goes to 140, okay? And this can very likely happen, but the theory is that if it's trading up here at 183, it's likely that if we were to buy the stock down here, right, at 160, even if the stock were to drop that significantly that quickly, it's likely that it would be overextended to the downside. It would then make a quick recovery up, and then we can get some relief and get out of those shares that we now own by selling covered calls, right? So this return here is just for the put, but if we were to be assigned stock, right, assigned stock, we can then sell covered calls on those shares, right? So that's the basis, that's the basic premise behind the ER gamble. And now we're going to talk about, can we make this small account friendly? And the answer is yes. And how we can do that is by using something called a credit spread. And since earnings cause high implied volatility and credit spreads are better during high implied volatility environments, we can do something like this, where in our original example, we were, let me just draw this out. So it was the 160, we were -1 of the 160 put. Now what we can do is we can buy an option and create what's called a credit spread by buying, say, +1 of the 155 put. This creates a limited risk, limited reward situation where all it has to do is the stock needs to stay above 160 by expiration, similar to before, but now we've created a situation that requires far less capital, far less buying power, and can be accomplished on any account pretty much. Okay, next, we're going to talk about what I like to call the falling knife strategy. And this is similar to the ER gamble with a few differences. And, I kind of joke with some of my friends who I trade with that this strategy can be summarized in kind of like one point, right? Which is this quote right here. It can't go much lower, right? And this, as you can see, I've included the clown face because so many times this has burned me, but I'm including it here because this is a high risk, high reward video. So the steps of the falling knife strategy are as follows. You're going to, number one, scan for the largest percentage losers of the day. Next, we're going to choose a stock from that list that we like to hold long term or that we're at least familiar with. Now, if you are familiar with scanning for the largest percentage losers, it's a lot of names you don't even know and that look super sus. But in this case, we're going to choose a stock we actually like and that we would own long term. And then what we're going to do is we're going to sell closer to the money 0.4 to 0.3 delta cash secured puts, which would look something like this, right? So we have our stock, it's moving as follows, and now it's a massive drop from where it's otherwise trading. And now we're going to sell kind of like close to the money puts below where it's trading around a 30 to 40 delta. So that's a 60 to 70% probability that the stock stays above that strike by expiration. And the rationale for doing so is that the stock now is theoretically overextended to the downside. So a recovery bounce is likely, right? So if the stock is now plummeting, we're kind of like selling a put below where it's already dropped. And then if we get those shares, selling covered calls then on the way back up. So you can see here, step 4 is if you are then assigned stock from that cash secured put, you can now own the stock at a steep discount and sell covered calls. So similar to the ER gamble, but in this case, we're selling those puts after it's already dropped rather than before. So that's kind of like the key difference. And the stock that I chose here as an example is UNH, United Health Group. And you can see here, the chart is just continuous blood. And this is a good example of one that could easily burn you. But if you play it right, can actually work pretty well. So in this case, I took the May 30 25s. And the other thing that I was going to include on here, I actually forgot to include it, is I'm going to add this as step 5, 7 to 14 DTE. And we're going to use 7 to 14 DTE contracts because we want to kind of like get in and out of these. We don't want to have a lot of exposure to a stock that's dropping like a rock, especially if we have the potential to have to own shares, right? So in this case with UNH, I'm picking 2 weeks out. And what I'm doing here is I'm going to the 30. You can see here I chose the put contracts that are 33 to 38 delta. And you can see here, I mean, the premium is just amazing, right? So probably about 1,000 in premium here per contract. And if these, if UNH were to continue dropping and you were to own the stock at 275, you now own it at a significant discount down here. If its regular trading range is up here, you can now ride those shares back up. And in the meantime, sell covered calls on those to earn even more premium. And again, let's ask this question. Is it small account friendly? I'm going to say this one, not as much, but like the ER gamble, what we can do is instead of selling a put or a call, we can do what's called a bull put spread, where we sell a put and then buy a put below to create a credit spread, which is limited risk, limited reward. Okay. Lastly, we're going to talk about what I'm calling the fad strangle. I completely made that up. It's complete nonsense, but this is something that if you guys are familiar with Tasty Trade, they'll occasionally do something like this. I'm not saying it's the exact same, but just had to include this picture in there. Okay, so the basic premise of the fad strangle is we're going to find a trending stock with high volatility. Because remember, high implied volatility means higher option premium, better to be a net option seller. So in this case, I'm choosing MSTR and DJT. These are just two examples of stocks recently that have fit this kind of like weird criteria. And the next thing we're going to do is sell a far out of the money strangle. In this case, for example, if the stock was trading at 100, selling a strangle means simultaneously selling cash secured puts as well as naked calls. So in this case, I sold to open 5 of the 120 calls as well as selling 5 of the 85 puts. And as long as the stock stays in this range by expiration, I keep the premium from both sides of my strangle and walk away without being long or short shares. So step 3 is going to be choosing 7 to 14 days till expiration. Again, we want to limit exposure on these riskier names because we have a lower chance of an explosive move if there's only 7 to 14 days before the contract expires. And number 4, which is important, use lighter position sizing here and do not be afraid to close the options early, right? So if we have this theoretical example here, and the stock starts really racing up in like a day or two after you enter, just buy the options back, take the loss, because the risk here is if you end up short shares of one of these explosive stocks that can move up 100 points, your ass is now in the air and you could easily get fucked. So in this case, lower position sizing. You don't want to have a explosive move go against you where you're short or long shares. And lastly, is this small account friendly? The answer is yes. This is one of my favorite trades here, which would be adding, again, like I said, plus 5 calls. Not put, plus 5. Wow, can't write. We're going to add plus 5 calls here and plus 5 puts down here, right? So this creates what's called a iron condor. And the criteria for max profit is the same as long as our stock stays between the sandwich of the 2 short strikes. This is going to expire worthless. This is going to expire worthless, and we're going to collect double premium. Far less buying power, far less risk, and there's endless variations of this strategy, which if you are a part of my community of absolute option killers who print money, you will learn more about strategies like this and how to implement them on your account size. So if you did find the fad strangle, the falling knife, and the ER gamble helpful, leave a like on this video, subscribe to my channel. We're growing very slowly but surely. Click the link in the description if you want to book a one-on-one strategy call with me. Glad to help. I show up to the call personally, discuss where you're at, where you're going, and how I can help you. But like I said, leave a like, subscribe, and I will see you guys in the next one. Peace.